Hi everyone. I wanted to speak with you for a few moments. I wanted to post this little mini lecture to help you organize the material that you need to know to do well on Quiz 5. Quiz 5, as you know, covers chapters 10 and 11. But there's also some stuff on monetary policy, which is the basic topic of Quiz 5, that spills over into chapter 12. Now, chapter 12 is on aggregate supply and aggregate demand analysis, and this is going to be the topic of Quiz 6. So that's the problem, I think, with this textbook, that a lot of the subject matter tends to be spread out too thin and spills into other topics, into other chapters, and not well self-contained. So let's consider some of the material you're going to need to know for this quiz. Once again, is about money and monetary policy. So the first topic, what is money? Frankly, money is anything that performs the functions of money. So money is defined in terms of its functions. There are three basic functions of money. One is to act as a medium of exchange. By being a medium of exchange, money overcomes the encumbrances of barter. Barter, as you know from the reading entitled Introduction to Capitalism, one of the first readings you had to do this semester. This essay is in the course document section. Barter is exchanging goods for goods, and in order for barter exchange to occur, there needs to be a double coincidence. Now, for reasons that are explained in the essay, money reduces the number of coincidences necessary to make a trade from 2 to 1. With money, you only require a single coincidence, and that's what facilitates trade. And after all, it is trade and exchange that determines how fast or how slow our economy goes. So we don't want anything slow it down, particularly the encumbrances associated with barter. The second thing that money does is act as a unit of account. This is second in no particular order. A unit of account. That means that we can express prices in terms of money. We don't have to express the price of a cup of coffee in terms of beaver pelts or the number of dolphin teeth or whatever it is. Prices in terms of money. Money, therefore, acts as a unit of account. Another thing that money does is it helps us to store wealth. Money acts as a store of wealth or a store of value. I'm going to allude to that again in just a few moments. So money is defined in terms of its function. Medium of exchange, unit of account, store of wealth in no particular order, or store of value. I believe their authors use that term. Okay, what does the money supply consist of? There are three basic assets that the money supply consists of. Coins, currency, and checking accounts, which are also called demand deposits. Coins and currency is money that is issued by the federal government. Now, coins and currency are called token money. They're called token money because their intrinsic value, the value of the materials of which they are made, is far less than the exchange value. Clearly, there's far less than $10 worth of material in a $10 bill. Far less than 5 cents worth of nickel in a nickel. So why do we accept them then? We accept them because the government proclaims that they are money and requires that you accept those as money if they are tendered or offered to you in the proper amount. And therefore those assets, coins and currency, are called legal tender. Now, checks, although not legal tender, they are often accepted as money and therefore considered money in the narrowest sense. The narrow sense of money, M1, coins, currency, and demand deposits. A broader conception of money is what's called M2. This also includes savings accounts and other, what economists call near monies, other financial instruments that are highly liquid. Now, banks are mere middlemen. That's what banks do. That's how banks earn their money. They act as middlemen. They bring together people with money to save and people that want to borrow money. People with a surplus of cash and people with a deficit of cash. Now, you could find somebody to borrow your money and pay rent on your money if you had a surplus of money, but it's far easier to use the bank. You don't have to do background checks or anything like this. So a bank is merely an intermediary. Keeps an inventory of money and lends it out. Okay, the inventory is provided by you, the saver, and it lends it out to the borrower. Now, it pays the saver one thing, charges the borrower more. And so the spread there is the profit to the bank. The American banking system, as with the banking systems of all industrialized democracies in most developed countries, is called the Fractional Reserve System. The Fractional Reserve System. Now, the term Fractional Reserve System is not mentioned by the authors. What that means is that only a fraction of the deposits into the bank are actually held in the vault. The rest of it is lent out to people, to borrowers. Only a fraction of the deposits into the bank are held in the vault. That means if all of the depositors at any one time came to get their money out, they wouldn't be able to do so because not all the money is in there. Now, they keep enough in there so that when you and I go to get our piddling little amount out, there's plenty. And as long as we have confidence that there will be plenty of money for us, we're not worried about the fractional reserve system. But if for one reason or another the population began to think that, well, maybe there wouldn't be enough for us, maybe people are going to start going bankrupt or broke or whatever, not be able to pay back their loans, there won't be enough for us, I better get my money out while the getting is good. And so we would all rush to the bank, run on the bank in order to get our money before they ran out. Well, this wouldn't be good, and this would mean a collapse of the American banking system. In order to avoid something like that, the government, the federal government, provides insurance. The Federal Deposit Insurance Corporation, the FDIC, provides insurance that says, hey, if you can't get your money out, we'll pay you. Now, the textbook says that the deposits are insured up to $100,000. In the last couple of years, I believe in 2009 actually, maybe 2008, I can't remember right offhand, it's not important, that changed to $250,000. So your deposits are insured up to $250,000. Okay, so let's now talk about monetary policy. The way in which the government can smooth out the business cycle. Now, the monetary policy is controlled by the Federal Reserve System. The Federal Reserve System is a system of 12 kind of central banks, and the Federal Reserve System was established in 1913, and its goal was to, well, one, regulate the currency, because in the towns out west back in 1913 the banks were issuing their own currency, and one currency wouldn't trade in some other town or something like that. Oh, it was a mess. So one of the first things that the Fed had to do was to standardize the currency. Another is to regulate the banks, make sure that they weren't running off with the people's money, keeping it in the vault and doing just like they were supposed to do. And in around 1930 or something like that, their role expanded a little bit and to affect interest rates. Now, here is the way in which the Fed can influence interest rates. Actually, I've only got 1 minute left in this video here, so I'm going to make another little video to discuss with you the way in which the Fed controls, or rather doesn't control, but influences interest rates. And so stay tuned for the next little video. In the meantime, if you have any questions, be sure to post them in the Quiz 5 forum on the discussion board. Stay tuned. There's another video coming right up.